Welcome to Group Insurance Daily Pulse, your 15-minute high-octane dive into the market-moving news you need to know. Brought to you by Aria the Actuary and Dorian the Distribution Expert. Get ready for data, analysis, and unvarnished truth. Good morning, Group Insurance Mavens. Dorian, your distribution expert, here fired up and ready to dissect the latest market shifts. Joining me, as always, is the inimitable, the incisive Aria the Actuary. Aria, good to have you.
Dorian, fired up is one way to describe the current actuarial landscape. Under duress might be another. Let's get straight to the numbers. We have a packed agenda.
Absolutely. First up, a significant strategic play, signaling strong sector growth and technological integration. Principal financial groups move to acquire Beam benefits. This is a game changer for Ancillary.
Game changer, Dorian, or a calculated risk with a potentially high integration friction coefficient. Let's unpack your specifics.
Facts first, Aria. Principal Financial Group has entered an agreement to acquire Beam Benefits, a membership-based dental services firm from a private equity fund controlled by Banner Capital. Beam also offers vision and other non-medical health benefits, currently serving approximately 25,000 small businesses. This is about market expansion, pure and simple.
Market expansion is often code for premium acquisition at a potentially inflated valuation. Beam recorded $175 million in premiums in 2025. But look at the underlying loss ratio on that book. What's the claims profile for a membership-based model versus a traditional insured product? We're talking about a firm being sold by private equity. Their exit strategy is inherently focused on maximizing return, not necessarily long-term actuarial stability.
But look at the synergy, Aria. This acquisition is projected to accelerate premium and fee growth for Principal's specialty benefits segment towards its medium-term target range of 5 to 9% by 2027. Principal already serves 180,000 employers in dental. Beam brings a tech-forward, cloud-based, AI-supported platform. This isn't just about adding lives. It's about enhancing the delivery mechanism, streamlining benefits, and improving the employee experience, particularly in the competitive SMB market. Think about the digital toothbrush integration for oral hygiene tracking. That's innovation driving engagement and potentially influencing claims frequency.
Potential influence is not actuarial certainty, Dorian. My concern is the integration risk. We're talking about merging systems, data architectures, underwriting philosophies, and claims adjudication processes. What's the projected integration cost? What's the timeline for achieving full operational synergy, given the deal isn't expected to close until the end of 2026? That's a significant regulatory approval cycle, implying complex compliance frameworks to navigate across multiple state departments of insurance. And the 5% to 9% growth target post-2027, that's a projection, not a guarantee. We need to see the underlying assumptions for medical inflation, utilization trends, and customer retention baked into that forecast. Principal's commitment here is to leverage technology. Beam's cloud-native architecture offers scalability and agility. Brokers and consultants will see more integrated, technologically advanced solutions, simplifying administration for employers. This is about reducing friction, enhancing the value proposition, and ultimately, market share capture. The digital toothbrush isn't just a gimmick, it's a data point, a behavioral incentive that could lead to better oral health outcomes, which directly impacts claim severity over time. It's a proactive risk management tool, not just a reactive claims processor. Proactive data collection is what it is, Dorian. The actuarial question remains, how is that data integrated into the risk model? Is it robust enough to justify lower premiums, or is it simply a marketing differentiator? We need to see the correlation between tracked oral hygiene and actual claims experience to validate any P&L impact. And let's not forget the regulatory scrutiny on data privacy and security with such a platform. Any breach could negate all projected goodwill and market share gains. The due diligence on Beam's proprietary algorithms and data governance needs to be ironclad.
It's a strategic move, Aria, positioning Principal for future growth by embracing innovation and expanding its footprint in a high-demand segment. The market clearly values this type of forward thinking.
The market values perceived value. My desk deals with real value, derived from robust underwriting, compliant operations, and sustainable profitability. Let's see the pro forma financials post-integration. The devil, as always, is in the details, and the details here are complex operational and regulatory hurdles. From strategic acquisitions to operational efficiencies, let's pivot to a tangible improvement in the enrollment workflow. Reliance Matrix, on July 9th, announced a significant enhancement to its Employee Navigator integration, a new Evidence of Insurability, or EOI, API. This is pure friction reduction, Aria. Friction reduction often precedes unforeseen systemic vulnerabilities, Dorian. Let's examine the architecture.
This is about seamless user experience. The new API allows employees to complete EOI requirements directly within the Employee Navigator enrollment workflow. No more external links, no more manual form submissions. Underwriting decisions are automatically returned to Employee Navigator, drastically reducing manual follow-up and administrative steps.
Automated underwriting decisions sounds efficient, Dorian, but it also raises immediate red flags regarding the integrity and auditability of the process. What are the specific parameters and rule sets governing these automated decisions? How are exceptions handled? What's the error rate post-implementation testing? An API, by definition, is an interface. We need to ensure the data transmitted is secure, encrypted, and compliant with HIPAA and state-specific privacy regulations. The goal here is data accuracy and speed. By keeping the process within a single platform, you minimize data transcription errors. The system is designed to return real-time underwriting decisions, dramatically shortening the wait time for employees. This leads to higher employee satisfaction and greater participation in voluntary benefits, directly impacting carrier premium volume and broker commissions. It's about converting more leads faster. The efficiency gains for HR teams are substantial, freeing them up for more strategic initiatives rather than chasing EOI forms. Efficiency cannot compromise actuarial soundness. How is the underwriting rules engine within the API validated? Is it static, or does it dynamically adjust based on new claims data or regulatory changes? What are the audit trails for each automated decision? Regulators will demand clear documentation of how a decision was reached, especially for declinations. The potential for fraud, while hopefully mitigated by sophisticated algorithms, must be rigorously tested. Are there human override points? What are the escalation procedures for complex cases? A fully automated system, while appealing for its speed, can become a black box if not transparently managed and regularly audited. The cost of rectifying a widespread error in an automated system far outweighs the administrative savings.
This is about meeting the digital expectations of today's workforce and employers. It's about competitive advantage through technological leadership.
Reliance Matrix is demonstrating a commitment to supporting its partners and clients with best-in-class tools. The market demands this level of integration. It's a net positive for market penetration and client retention. Market penetration is moot if the underlying risk is mispriced or unmanaged. My concern is the robustness of the backend. An API is only as good as the data it processes and the rules it enforces. The ease of use must not mask a lack of rigor on the actuarial or compliance side. We need to see the specifications, the security protocols, and the independent audit reports. Without that, it's a black box, and black boxes make actuaries very, very nervous. All right, Aria, let's shift gears to a topic that's been dominating the headlines and impacting every facet of our industry: the proposed double-digit premium increases for ACA plans in 2027. This is a tough pill for everyone. Tough pill is an understatement, Dorian. This is a direct hit to carrier P&L, employer budgets, and employee pocketbooks. On July 9th, many ACA insurers proposed median rate increases of 14% for 2027 in preliminary filings. This isn't speculative. It's based on analysis across 16 states and D.C. This is a solvency concern, not just a market adjustment.
And the drivers are clear. Rising medical costs, particularly the growing demand for costly specialty medications and GLP-1 weight loss drugs. PwC forecasts a 9% rise in costs for job-based health coverage in 2027. We knew this was coming, but the magnitude is striking.
The magnitude is critical. A 14% median increase for ACA plans, with specific carriers like United Healthcare citing new rules and the expiration of enhanced subsidies accounting for 12.7% of their requested rate change in New York alone. This is not just medical trend, it's also policy-driven. For group health carriers, this pressure on ACA underwriting strategies will inevitably spill over into employer-sponsored health plans. The actuarial models for both segments are interconnected. We're looking at increased loss ratios, potential reserve inadequacy, and significant strain on capital requirements if these increases aren't approved or are insufficient to cover the escalating claims.
For brokers and consultants, this means incredibly challenging conversations with employers. It requires innovative plan design, benefit optimization, and clear communication strategies to manage employee expectations. We'll see a renewed focus on high-deductible plans, health savings accounts, and perhaps even a reevaluation of ancillary benefits to offset rising core health costs. Employers are facing a triple whammy of higher premiums, expiring subsidies, and potentially increased out-of-pocket costs for employees.
Navigate is a euphemism for absorb the shock, Dorian. The core issue is the underlying medical trend. GLP-1 drugs, while transformative for some, come with a significant price tag and long-term utilization patterns that are still being modeled. Carriers need robust formulary management strategies, potentially tiered benefits, and aggressive negotiation with pharmaceutical companies. The risk adjustment mechanisms within the ACA framework will be under intense scrutiny. Any miscalculation here could lead to adverse selection spirals. This isn't just about plan design. It's about the fundamental economics of healthcare delivery and the regulatory environment. We're approaching a critical inflection point where affordability becomes a severe barrier to access.
But it also presents an opportunity for carriers who can innovate in cost containment, perhaps through value-based care models or by providing robust wellness programs that genuinely bend the cost curve. The market needs solutions, not just rate increases. Brokers will be looking for partners who can offer creative solutions to mitigate the impact on employers' bottom lines and employee retention strategies.
Creative solutions need to be actuarially sound and financially sustainable. The P&L impact of a 14% increase cannot be wished away with wellness programs alone. We're talking about fundamental shifts in healthcare costs. The solvency implications for smaller carriers heavily reliant on the ACA market could be severe. Regulatory bodies, particularly state DOIs, will be under immense pressure to balance consumer affordability with carrier financial viability. This is where the rubber meets the road. The risk versus risk-reward equation is becoming increasingly skewed towards risk. This is a solvency event in the making for some.
A challenging period, undoubtedly, but one where strategic partnerships and innovative distribution will be more critical than ever.
Indeed. The only certainty is continued volatility.
And that wraps up another intense edition of Group Insurance Daily Pulse. Thank you, Aria, for your razor-sharp insights.
Always a pleasure, Dorian, or at least always necessary.
For Group Insurance Daily Pulse, I'm Dorian, and she's Aria. We'll be back tomorrow with more market-moving news. Stay informed, stay strategic.